Hi, Tim Bigham for Delta Derivatives, Option Hedges and Edges, powered by the best option scanning tools on the market today, rbtrader.com. And seeing a market that just keeps powering higher unrelentlessly. London attacks, tragedy that they were, certainly didn't put much of a dent, if any, in the market. So we see the VIX, which yesterday closed with a 10 handle, actually lower again today. Option prices, again, the VIX is a measure of implied volatility. Implied volatility, as we've always talked about, just another way to say the price of the option. So option price is getting very cheap. Great time to be using option strategies to express a directional or non-directional opinion, although selling outright options here at such low levels of implied volatility, you really become what's short gamma, which can be very nasty if it goes against you, similar to what we saw last week when we had that big tumble with the VIX spiking up over 16 intraday. Can lead to some serious, at least mark-to-market losses. But I'm looking at using put calendar spreads here as kind of a trade structure across the board on some of the high flyer names, Tesla, Nvidia, and the like, with turn of the month coming up, which is the last 3 trading days of the month, the first 3 of the next month. That comprises about 77% of the overall market gains since 1990. So normally a very bullish period. So I'm simply selling this Friday slightly out of the money puts, for example, on Nvidia, the 135 strike, buying the regular June 135 puts, setting up in a slightly bearish trade structure. More importantly, I'm long vol by doing this. So if we do get a pullback and the concomitant spike in implied volatility, this trade structure will be a double winner. Same thing with Tesla. I think Tesla, hard pressed to see the company earning money anytime soon, given kind of the Model 3 sort of analysis that you can see out there. So with Tesla using the 300 puts that expire this Friday, buying again the regular June 300 puts. And then I have 2 weeks in the interim to sell additional premium against that. So just looking for a bad hair day along the way. So that's kind of my trade structure du jour. You can use it on the indices as well. Certainly with vol so low, implied volatility, again, the VIX at 10.5, just outright option buying. Whether you're bullish or bearish, certainly nothing wrong with that. But the fact that we're going into a 3-day weekend, I might want to defray a little of the cost on my index play. So on the SPY, I'm buying the regular June 235 puts, selling a few less of the Mays that expire this Friday against it, defray some of that premium decay, and again have the interim kind of 2 weeks to sell premium against it. So this market just seems to just keep wanting to go up. At some point, I think we will have something really bad happen that might shake the confidence, but until then, I think positioning slightly bearishly, slightly long vol is probably the best way to go here. So until next time, as always, here's the good trading. Take care.